The US Federal Reserve has today announced it'll leave interest rates on hold at a 25-year high of 5.25 to 5.5%. But the central bank's Chair Jerome Powell has signalled they expect to cut rates 3 times this year if inflation continues to decline towards their 2% target range. Let's bring in the independent analyst, the best man in the business, Evan Lucas. Good to chat as always. So what did you make of the figures this morning?
Yeah, it was fascinating. He made it very clear that he is almost suggesting that what's happened from December, January and February, where inflation has not just flatlined, it's actually slightly ticked up in a couple of those months from the month before, is part and parcel with where they expect it. He also highlights very clearly that he's not concerned by that in any shape or form. And as he said, they are going to cut rates 3 times this year. That is one less, though, than what they were forecasting in December. So in December, the board was forecasting 4 this year, not 3. But they have moved that 4th one out to 2025. And by 2026, they actually believe the federal funds rate will be back to 2.6%, which is slightly higher than what they were forecasting before. But overall, it is not just around the inflation story, but the other question that everybody was asking was about employment. And if you have a listen to what he said, he is actually completely fine with employment getting stronger. He said it's part and parcel with where we're at, and it will not change our outlook. What he did highlight, though, was that if employment was to considerably deteriorate faster, that would bring it forward. So all of that sort of confirmation that they're still on the same path, that nothing's really changed despite the data being stronger, was an absolute off to the races movement, and it's seen the Dow and the S&P to record all-time highs, both on an all-time intraday and on the closing.
So how would that fit in with our story here, Evan? How might the RBA be looking at that?
Yeah, and that's the great question, because that's what I think everybody this morning has been debating about. Okay, if the Fed is okay with inflation being a little bit above trend, don't forget they're still 1.8% away from their target of 2% at 3.8%, and we are just over 2% away from the bottom, but we're only 1.1% away from the top of the band. So the suggestion here is that, okay, we listen to what Michelle Bullock said on Tuesday. We look at what their assumptions are and how their assumptions sit. The assumptions show that they are also expecting to cut rates this year and into next year, with 2 this year and 2 next year, to make sure that they maintain at a full employment number, growth slows but not to a level of recession, and that they manage to get inflation back to their target over the next 2.5 to 3 years. Now, she did highlight very clearly that if that was to start pushing out, that if inflation was to start getting a little bit higher than they wanted, that might change things. But what the Fed is telling us, and what we can infer here, is that from their perspective, 1 or 2 months of slightly higher inflation is not the problem. It's a trend. The trend is still very much on the downside, and it's the same here in Australia. Our trend is to the downside when it comes to inflation.
All righty. Evan Lucas, good to see you as always. We'll chat again soon.